Welcome to Speidel's California Minute. I'm your host, Catherine Zidane. This week we're talking about tax planning for dissolutions that happen at the end of the year. Attend Speidel's federal and California tax update and get everything you need to be prepared for tax season. You can see a list of topics and get registered for an in-person seminar or live webinar at speidel.com. A business no longer has to dissolve before the end of the year to stop the $800 annual tax from accruing for the following year, but planning for the tax consequences of the dissolution is still important. The FTB will not assess the $800 minimum franchise tax or $800 annual tax for any business entity for a tax year, specifically for an LLC, corporation, LP, or LLP, if the entity timely files a final tax return on or before the extended due date for the preceding taxable year, if the entity does not do business in California after the end of that preceding year, and if the entity files a certificate of dissolution, certificate of surrender, or certificate of cancellation with the Secretary of State before the end of the 12-month period beginning with the date the final return was filed. File the final year tax return and check the applicable final return box on the first page of the return and write final at the top of the first page. Again, the entity has to cease doing or transacting business in California after the final taxable year to stop additional $800 tax liabilities from being incurred. As an example of the general process, assume the XYZ Corporation closes shop in November 2025. It files a final 2025 return on March 16, 2026, which includes an $800 minimum franchise tax payment for the 2025 tax year. XYZ conducts no business after November 2025, so XYZ will not have to pay an additional $800 tax after it files its 2025 return, even though it doesn't file its dissolution papers with the Secretary of State office until November 2026. For dissolving entities, we recommend paying the final year tax preparation fee during the year of dissolution. Many times, the only expenditure after the end of the year is the tax preparation costs that are paid by a shareholder or partner or beneficiary who can only use it as a miscellaneous itemized deduction, and this generally provides no tax value to the client. By paying the fee early, the client receives a timely deduction and the preparer receives payment earlier. The same will hold true for any expenses that might come due in the following year, like legal fees and cleanup expenses. California does not allow a cash basis taxpayer to accrue deductions into the final year if they weren't paid until the following year. If an entity dissolves prior to filing the final return, remember that the taxable year ends in the month the entity is dissolved, and the final tax returns will be due earlier than the normal due date. For example, a calendar year S corporation that dissolves in October will have an extended filing deadline of July 15th, not September 15th. Dissolving during the month of December will not create a short year. To stay up to date with California tax law changes, subscribe to Speidel's California Tax Letter. This monthly newsletter is written by California tax pros for California tax pros in plain English with helpful examples and charts. For subscription information, go to speidel.com and click Publications. That's all for this week. Join us next time for another episode of Speidel's California Minute.